Today, we're going to be speaking about layoffs, whether unemployment is going to start really skyrocketing and putting a bit of a spanner in the works of central banks' monetary policy. And the trade in Takeout today is going to be revisiting exactly why it's important to focus on moving averages, to be able to come to a more objective decision about trend following. If you want all of these tips, this market news and commentary to your YouTube feed every single weekday, then make sure you hit subscribe and also like this video. I like to keep a seriously keen eye on the state of the jobs market, the labour market, purely because this is the component that I deem to be so important in the whole decision-making part of macro now. It's the one factor of the market that hasn't shifted whatsoever, but it's entirely the most important as well. So the way that we have to be looking at this is, okay, through 2023, we've had a hell of a lot of layoffs, actually. And in front of you, you can see the chart that I've got here from layoffs.fyi. Employees laid off are extremely high in Q1 of 2023 and also, through 2022 as well, the back end of it. They reached sort of a peak in 2023. Now, tech tends to have a hell of a lot of bloat, so they overhire and they decide to increase their hiring massively and then cut back. I'm not too sure why they do this, but it's why you probably see a product manager role times a billion for some reason. I genuinely do not know what a lot of these people do, and I used to work at one of the world's biggest fintechs. So I've experienced many other firms with a lot of bloat. Now, you can see since then that the amount of companies have been declining with layoffs. So you can see that in blue, which is, this line basically going down this way. So there's been a downward trend, but one of the big issues that I'm seeing is that banks have started to cut back massively. And I'm just going to share a Reuters article with you from, I think it was Friday or Saturday. So Citi to cut 20,000 jobs post $1.8 billion loss in a disappointing quarter. Now, this is probably due to the reversion in bond yields, perhaps, I'm not too sure, which means that their net interest margin reduces. That's how banks make profit. They make profit when they can charge interest, right, from lending. And if lending's down, because rates are up, then they're going to be making less. But generally over a shortish period, they can make money when rates are higher, when bond yields are higher. But it's been funny enough a weird year for banks, because although they've made a ton of money, they've also been cutting jobs. Barclays cut 5,000. I think JP Morgan cut jobs. I think BlackRock has just announced that they're going to cut about 3% of its workforce as well. So it's sort of a really sticky predicament that we're going into. And naturally, the banking sector is very sensitive to future economic expectations and future economic events. So this is definitely something that we should be paying close attention to, in my view. Now, I just want to reverse back to inflation and US inflation, because I feel like we are, again, and I want to reiterate this, back at this point here. I'm worried and concerned that inflation could reaccelerate, and that will be a massive trade, because what we're going to see is people that have been hit once on having to revise their spending and behavior on interest rates going up. They're now revising their behavior on interest rates potentially going back down, but then they might have to revise it again with rates going back up. This is not good for certainty or markets. Markets love certainty. It doesn't matter which market you're in, whether it's a job market, whether it's, the housing market, whether you're just trading. For traders, it's probably good because there's volatility, but for longer term investors, it's a tricky one to cope with. So this will be very interesting if we are seeing a repeat of this. And I really hope we're not. But as I said last week, you've got to be aware of it from an asymmetrical and low risk to high reward possibility if you're able to catch a trade at the right time. But generally, that's not good anyway, because other parts of your life can be affected, which actually makes, winning a specific trade rather meaningless. because if interest rates were to accelerate again and unemployment were to increase, it just makes the market and economy generally bad. Could mean disinflation/deflation, but at the end of the day, you don't want deflation if there's mass unemployment. It is not beneficial for anyone. And that's why I always say to people, okay, you want prices down, but do you understand what might cause those prices to be down? Do you get that it could mean that, people are losing their homes? Do you get that it could mean that people are unemployed? So if we head back to this unemployment factor, yes, it might mean the prices come down, but at what cost? At what true cost to the economy? So I just wanted to share that with you today. So, we're getting into a position now where banks are becoming really, really sensitive to the employment market. It doesn't necessarily mean that it's a precursor. It means that they might have had a good few years too. And so now they want to cut their workforce down a bit. But generally, I would be cautious to see what their reasoning is for cutting workers, whether it's due to upcoming economic conditions, bank conditions, whether credit is becoming really, really tight. What are they foreseeing? That is a question that you've got to ask yourself. Now, today's trading takeout is on something that's quite important, and it is objectifying the trend. Now, how can you objectify something? Well, you are able to do that by using something like a moving average. And I think moving averages are probably the best way to be able to do this objectification of a trend. Now, why is that? Well, it's using quite a lot of data to be able to come to a decision over a certain time period as to whether something is above the average or below the average. What does that mean? If you're above the average, it means that you're trending to the upside. If you're below the average, it means you're trending to the downside. But there's two different ways in which you can interpret this. Now, we know, and I've spoken about it from previous videos, that markets tend to either trend or mean revert. They mean revert about 70 to 80% of the time, and they trend about 20% of the time. It depends on the time frame, but of course, what we would be looking at is the longer term trend. Now, the longer term trend in indices, because of the way that an index is comprised, is up generally. Okay. It's because the weaker firms are replaced by stronger firms, which leads to a support level in the index. So you can probably look at this and say, all right, well, if something is well under, the longer term moving average, it means that there's some form of likelihood that it wants to return back to either the moving average or above the moving average to regain a stronger trend. Taking this information, it means that you can then develop some form of strategy. So if you want to look at standard deviations or a percentage move away from the moving average that you found through testing over time, the extent to which it becomes more of a success, then these are the ways that you can start incorporating these beliefs into the market. If you think perhaps that you're better at selling a market, then you can do the opposite in a stronger uptrend. So various ways to objectify something rather than saying, oh yeah, that looks like it's going up, which it absolutely might be, but there's more nuance to it. Use these indicators. Don't be put off by people that say don't use indicators, because I think they're the best way to understand data rather than just having your subjective human biases put on top of it.